All right, join us now, David Albrycht, a five-star bond portfolio manager at Newfleet Asset Management, like $10 billion in assets. And really, in the last 3 weeks, you've been really, your moniker is Midas. I mean, you have been the greatest manager of money I've seen across the board of anyone. Everything you've touched in the last 3 weeks is
Thank you very much, Joe.
Isn't it true? I mean, it's crazy. You feel smart?
Well.
You feel smart?
Unfortunately, the equity markets haven't done that well.
Well, yeah, but let's talk fixed income. I mean, is there any area, I guess bank loans,
bank loans and high yield, which are the most equity correlated.
And they haven't done as well.
Well, I mean, high yield's off 1.5 points, loans are off less than a point.
What did you make in munis in the past month?
Munis, well, let me give you an example of what came. The muni market is seeing massive inflows. Last year, 93 billion record inflows, 30 billion this year. Buckeye brought a deal, tobacco deal in Ohio. We bought the triple B tranche. It came at 100 off. Within 3 hours, it tightened 50 basis points. It was up 5 points. Insane. 25 times oversubscribed. It's sort of an irrational market right now. We think that if any market is full in value, high-yield munis and munis. High-yield munis are up 4.5% year to date, which is a little crazy, a little counterintuitive with risk assets trading off. It seems like there's an irrational exuberance definitely in the muni market.
There's been an irrational exuberance in the bond market for, 3, 4, 5 years. There's been so many times where it's like, God, I wouldn't dare to put any of my money there. And every time, no matter how long the duration, you would have done okay.
Yeah, I mean, treasuries are up 5.2%, high yield munis up 4.6%.
It's got to be that. This is it now. I got to be it now.
If you're late to the defense game here, where do you buy in the bond market, right? Because I think people right now are worried it's too late to get out of equities. We're down too much. I don't want to sell at a loss. It's too late to get into bonds. Where are the opportunities? Do you still buy corporates? Do you buy munis?
So, I mean, we've done it up in quality trade. We've been doing that trade for the last 18 months, so we're pretty well positioned. We've bet on the consumer, so we've done jumbo mortgages, we've done a lot of asset-backed securities, which are extremely liquid, high quality, and now we have plenty of fuel for the fire. I've been taking an opportunity to fill out positions that just 10 days ago were expensive. QVC, Stations Casino, Ladder Financial, Neighbors Energy, Charter Communications. So taking gradual bits and pieces. We're a dollar cost averager. It's not all or nothing. If you're not in the market as of now, you should have some diversification. You should always be in bonds. But one thing right now is looking very, very good, Joe. Cash at 1.5% versus a 10-year at 106.
Does that last?
I'm not sure how long it'll last, but it does seem like an attractive alternative.
When you say what you've been buying, obviously that's on the corporate side,
yes.
Right? So that means you, assumedly, you don't expect some nasty kind of erosion of credit conditions here. I mean, I'm trying to read how the credit markets have responded, because it seems like this has been mostly an equity-led mini panic.
It has. So, I mean, you got to be very careful. And to your point, active management and credit selection has never been more important. There's been a lot of fallen angels. We've avoided high yield energy, which is down 8.8%. We've avoided some of the blowups in emerging markets. If you were in Argentina, Ecuador, Lebanon, those are off anywhere from 10 to 43%. And a big bet coming into the year we made is to stick with the U.S. dollar, the highest yielding G3. The U.S. dollar, if you look at currencies with the exception of the yen, they're off anywhere from 3 to 10%. So, you have to pick your places, pick your spots. But credit, watch very, very closely. It's a case-by-case basis. You don't want to be in an index if you're in, the more esoteric sectors, high yield and bank loans. You want to be able to pick credit.
Can I just ask both of you, does this feel like this type of situation where, okay, we've gotten scared, but it's a buying opportunity? Or does this feel like, we've gotten scared and there's going to be more panic to come?
I'll answer that for the equity market. So we're down 12.8% from the high on February 19th. On average, the equity market is down about 14% every year. So 12.8 is still less than that. And I think if we aren't nearing a recession, so if you believe that we're not going to go into recession because of this, a bear market or a correction without a recession is usually about 15 to 25%. So we still have more room to go on the downside before I think we hit that bear market trigger and some of those algos come in and say, you know what, we don't deserve to be in a bear. I don't know that this is a time when jittery investors should try to throw new capital into the market, but I do think for the moment it's worth riding out.